watching First Business. Financial news, analysis, and today's investment ideas.
Good morning, everybody. I'm Angela Miles. Thank you for joining us today on First Business. Coming up in our show, capitalizing on Twitter, how the social network is helping traders make money. In today's cover story, startups soar. Could this be a blowout year for tech funding? And odd jobs. One man plays personal trainer for corporate America as a woman finds her sole passion making shoes. Plus, in Traders Unplugged, how the guys plan to profit on this year's corn crop. Scott Fowler of Trading Advantage joins us now for the tricks of the trade. Thanks for being on our show this morning. And we're taking a look at how the presidential cycle affects the stock market. Is this something you closely follow, Scott?
Not as a trader on a day-to-day basis, but if you look historically, dating back, probably 70, 80 years, this actually does make sense. And there is absolutely a pattern to how the market works during the cycle. You look at it, and the year before the election and the third year into the presidential cycle have historically been the two best years of the cycle to be in the market, not only on the upside, but also those are the years with the least amount of decline. And, truly that makes sense. You have the year before the president takes office, it's election time, and everyone is positioning, both Democrats, Republicans are positioning what they're going to do for the economy, what they're going to do for taxes. It's more of a feel-good issue. Once they get in office, things seem to calm down a little bit. In fact, the first and second years after the president being in office are historically two of the least advantageous years in the marketplace. And then as it comes closer and closer to re-election, so that third year in office, that's when things pick up again. And there is absolutely a marked trend.
Would that cause you to put more money to work when you know that there's certainty, when you know who has won the election and that this cycle is in play?
If I wait till we find out who wins the election, there's only a 2-month window then between the election and when the president actually takes office. So you really have to be in the market that whole year, probably the 9 months before the election. That's historically when the biggest up markets have happened. Now, again, as a trader, I'm not necessarily looking at that. But if I was just, the public retail investor in my IRA account, something like that, that is definitely a factor to think about.
Thank you for your insights today.
Sure.
In our cover story, for those who dream of being the president of the company but just need a little seed money first, venture capital is heading in droves toward mobile applications. VC funding for mobile surpassed $1 billion in the third and fourth quarters of last year for the first time ever. That's just one key trend for startups in 2014. Venture capital investments in mobile and telecom startups went up 3% last year and now account for 16% of all VC deals. The mobile company that took home the most money was car-for-hire app Uber with $285 million. Uber launched in 2009 and now pairs drivers with passengers in 26 countries worldwide. At a seminar for startups, funding in 2014 will likely come from non-traditional sources.
The funding for startups in 2014 will be a lot of private capital through a lot of things like Kickstarter, Indiegogo, and places like that, and individuals who are going to be investing personally.
One startup, Context Media, which provides healthy lifestyle tips to patients in clinics, has grown annual sales into the multi-millions, allowing its co-founders to invest more than $1 million themselves in 22 other startups, many of them health-related.
There's two things that an entrepreneur within the healthcare industry should think about. One, it's not easy to sell to physicians. There are a few industries where the newest, coolest technology is not what everyone's turning to. They want tried, true, tested, and there's very little room for error. So products that have credibility of having tested partnerships with larger institutions, having done some beta testing on the ground, will have a higher likelihood of being adopted by physicians.
The seminar's organizers, Chicago Digital Startups Incubator 1871, also shared another trend: paring away business functions that are not the core of your business.
Wasting resources on HR, wasting resources on anything that isn't mission critical is important. Now, when you shrink it to that, then it's possible to stay on top of what's important to your business.
Tolman suggests that startups won't lose cost containment abilities by outsourcing because of increased competition among service providers. Overall, more venture capital money went to internet companies than anywhere else. Fourth quarter of last year, the strongest in 2 years.
The conventional wisdom that people who run companies in Silicon Valley are paid exorbitant salaries may be misguided. According to Business Insider, 75% of tech company founders pay themselves less than $75,000 per year. The data also shows that the younger the CEO, the less pay. Founders who are 20 or younger pay themselves around $35,000. Salaries don't tend to rise until there are at least 10 people on the payroll.
Meanwhile, the highest starting salary for an MBA grad in the class of 2013 is $375,000. That healthy paycheck's going to a 30-something graduate of Northwestern University's Kellogg School of Management. A Poets and Quants analysis of starting salaries for top graduates of the world's best business schools shows that after Kellogg was Wharton, with a graduate earning $350,000, followed by $310,000 at Columbia, $260,000 at Duke's Fuqua, and $250,000 at the University of Chicago's Booth School of Business.
Tech devices are helping slim down corporate fat. A company called Retrofit has devised a way to whip top executives into shape who spend their day sitting in front of computers. Retrofit provides one-on-one remote personal training through Skype video conferencing, a tracking device, and a Wi-Fi scale.
68% of Americans are overweight, so it's the vast majority. But more specifically in the corporate market, this costs companies a lot of money. Each overweight employee costs their boss $1,500 a year extra. So if you do the math for some of the companies we work with, Salesforce.com, Google, etc., hundreds of millions of dollars a year.
Jeff Hyman, the founder of Retrofit, says he has lost 20 pounds on his own program, and most senior executives in the program have lost between 20 and 50 pounds.
Paying for health care and exercise programs comes into play for the companies considered the top places to work. Silicon Valley tech firms ranked high on the Fortune list. Google is in the top spot, followed by software firm SAS. SAS has an on-site healthcare center that is also open to employees' family members. Boston Consulting Group, Edward Jones, and Quicken Loans also offered quality perks to employees.
Whether you are at the top of a company or closer to the bottom, financial planners say a rule of thumb is to save as much money as you can through your employer's 401k plan. One survey shows 61% of all U.S. workers have access to a company-sponsored pension or retirement plan. However, only 46% participate. The benefits to having money directly deducted from your paycheck and into your savings include paying less in taxes on your earnings, having a cushion on top of Social Security, and your savings could increase if your company matches your money.
You've heard the lament, I can't afford to retire, or 65's too young to retire. So more older Americans are starting businesses. Kaufman Fast Track finds nearly a quarter of all new startups were launched by people between 55 and 64. Bloomberg research shows baby boomers have an advantage in terms of starting a business, as the generation tends to be more educated and also have assets used to finance their startups. Michelle Markey is vice president at Kaufman Fast Track.
The older Americans do come to the table with some wonderful experience and a lot of history. But with that, they are also recognizing that there are certain things that they still need to learn about what it takes to launch and build a business.
Data from the Labor Department finds 65% of Americans ages 55 to 64 were working or seeking a job in 2012. That's up from 56% a decade earlier.
Social media has transformed from a fun way to share pictures and personal information with your friends to a sophisticated method of tracking the financial market. Diane Mocha has our report.
Far from Silicon Valley, Chicago-based Social Market Analytics has the feel of a West Coast startup. A trendy loft office with an open bar and drum set in the lobby, a team of hipster web developers and programmers, and a cool next-generation concept. Turn Twitter's nonstop traffic into relevant data that can be mathematically analyzed and spit out to traders.
Because I can give you a heads up when something's happening in the market.
Chartered financial analyst Joe Gitz says he founded Social Market Analytics because his clients kept asking for a way to track and quantify the market noise on Twitter.
The sentiment changes around the fire, around when Tesla tweeted about all over the country. So this was breaking in social media well before it came in the market as a whole.
The company's software grabs all 500 million daily tweets and pulls out only those from professional traders and key players. Then the system determines which of those tweets have relevance to the market and uses that chatter to generate a positive or negative sentiment score for the 3,000 largest publicly held U.S. companies, updated every single minute 24/7.
Twitter beats CNBC because so if CNBC is finding out about it on Twitter, we've already read it, quantified it, and sent it to our clients.
A stock research director from Zacks has his doubts and says investors want the kind of thorough and rigorous analysis that's outperformed the S&P 500 for 23 of the 26 years his firm has been providing investment advice.
I could pick a restaurant or maybe a movie or a book from the buzz or the Twitter feed, but I'll be very hesitant to recommend anybody to pick stocks.
But dozens of money managers and hedge funds are paying from $5,000 to $15,000 a month for SMA's constantly updated reports. And SMA just began offering a user-friendly dashboard to day traders for $29 to $99 a month. Partner Mike Grossman says investors who opened and closed the market trading SMA's sentiment winners would be up over 50% in the firm's first 2 years.
It has to prove itself over all parts of the cycle to be taken seriously.
Joe's team proved themselves to the New York Stock Exchange, who signed on as a distribution partner to provide its members with sentiment scores from SMA. Diane Mocha for First Business News.
The CEO of SMA says his report should be just one element of an entire model used to making buying or selling decisions about stocks. Coming up, spring cleaning your portfolio, insider tips on where money managers are investing. Plus, in Traders Unplugged, market clues on tech stocks that could rise to the top. And the story of how one woman followed her dream to success 1 foot at a time. She shares her story next with Bill Mahler.
How about this for a career, a shoemaker? Well, for Sarah McIntosh, that's not an anachronism. You design, you make shoes by hand, you run the Chicago School of Shoemaking. How do you get into shoes? You're an artist. You could have been a sculptor, a ceramic person, but shoemaker.
Yes, I started out wanting to make things, so it was a very broad field at the time. And then when we were doing a back to the land movement and building our own house and trying to provide all of the things that we needed for ourselves, I got to a pair of shoes that were starting to wear out, and I thought, well, perhaps I can make these as well.
And now you've got the school going, and you're an artist first. Did you know anything about running a business?
No, and over the years I really tried to train myself to keep records and to keep costs and things in balance, but it's been a process all these 40 years.
And in the last 2 years, your student body has grown by a factor of 4, and you're becoming more of a professional business person too. You've hired an executive director.
Absolutely, and it was very much worth it because all of those details are not just ingrained in artists.
Now, these shoes, as I handle them, these are some of the shoes that you made?
Yes.
These are not clunky creations. These are artistic. These are beautiful. These are distinctive. I assume that when you walk around with shoes like this, people say, where did you buy them?
Yes. Where did you get your shoes? Where did you get your shoes? And I said, when I say I made them, they are amazed. And it's such a romantic notion to make your own shoes.
Yeah, it's kind of an old world lost art.
Absolutely.
And your students, are they doing it because it's a hobby, or do they want to get into the shoe biz too?
I think it's both, Bill. They come to me because they're intrigued, and they take the 2-day beginning shoemaking class where they make this shoe, and they are so excited about the fact that they made something that's so tangible and so important to them that some of them want to continue.
Yeah, Imelda Marcos. I mean, there are people who know that shoes are a fashion statement, but these are a distinctive statement because if you've made them, that's something. You walk with maybe a little more spring in your step.
Yes, absolutely. And they're very comfortable as well because we build the shoes to the person's measurements.
How many people in the world do this?
I don't know. I think that there's probably a dozen of us in the United States, maybe more in some other countries.
Well, hats off to you, Sarah McIntosh. Thanks so much.
I appreciate it.
Thank you, Bill. Still to come in Chart Talk, profiting on a cure. A money manager tells us about a healthcare stock on his radar. And coming up next in Traders Unplugged, is 2014 throwing a curveball to investors? We'll be right back. Get some levity in your life. Joining us from the Flora CME Group, Alan Nuckman and Scott Shellady here for Traders Unplugged. Good morning, guys.
Morning.
Here's your topic number 1, down January. January was the first down month since May of 2013. What does this say for the rest of the year?
Well, looking at the Dow stocks, the Dow's been hit harder. It was down about 5% or so. It was up last year, obviously, but didn't participate as much as the NASDAQ. There are a lot of Dow stocks that are at some key levels of support. Coke, Home Depot, just Boeing. There's a lot of these stocks that you can look at from a risk-reward level. I think they have more upside here in the future.
I agree. I think by the end of the year, you'll be bruised and bloodied, but I think you're going to see some positive returns. I do think, though, the economy is not doing as well as Alan and his cohorts think it's doing, and we will see some type of stimulus other than QE. QE will be unwound through the taper because it's a bad economic policy, but not because the economy can handle it.
15,700 is the level to keep an eye on in the Dow.
Topic number 2, popcorn. We've had a record level of snow this year, so what will that mean for moisture and corn crops?
Well, the play on corn is that we're going to really need some sort of weather scare to get it kind of off the mat. There's been a lot of selling of at-the-money volatility, and rightfully so, because
so
it looks
from
as though
580 down to 420, the corn market's gone straight down. Could this cause a bounce with this concern if it's too wet in the springtime?
Maybe to 440, and if you do get that bounce, all the farmers that did not sell a thing this fall will let you have as much corn as you want.
So what you're saying is
make a house out of it.
That Mother Nature is guaranteed this year again. There won't be any problems. Everything will be fine.
No, I didn't say that.
From planting to harvest.
I didn't say that, but you're trying to guarantee me that something will bad happen. So
well, I think the reward potential is on the upside. $5 is the halfway point of this last sell-off.
And there's no corn that's going to come to market when you see 440 or 450.
Every year's a new market. Every year is a new year.
Except for the farmer did not sell their corn last year.
Topic number 3, we want to get your predictions on tape. Which tech stocks will perform the best this year? Microsoft, Yahoo, Facebook?
I like them all. Facebook's probably not as much, but I think Apple had a sharp decline, got to the halfway level of the October lows to the December highs. So want to see some recovery there, but the PE ratio is only at 12 for Apple. They're a serious money generating company.
I like Marissa Mayer, and I like Google. Google is going to come out with some more disruptive technology. I think
because she's pretty?
I think that ultimately it will be a tech wreck. You'll have some tech stocks that do better than others, but you have to remind yourselves that we've seen this 1999 to 2001 when we've got some companies like Facebook that are worth more than Boeing and Dow Chemical combined.
All right.
We do have a small problem there.
Google.
Everybody's got to really take a look at themselves in the mirror and realize what is actually produced here.
Let's talk about being a trader. Google sold off Motorola and lost $10 billion, and they're fine with that. So I think they're in very healthy shape.
Here's a bonus round question for today. Which one is not an actual ticker symbol? Corn, eat, and milk.
Milk, M-I-L-K. Moo!
I'll say eat, because I don't.
It's milk. We totally made that one up. Thanks for being on the show, guys. Have a good trading day. First Business continues right after this. Turning to Chart Talk this morning, Matt Shapiro, president of MWS Capital, is standing by. Good morning, Matt.
Morning, Angie.
Is it time for investors to do some spring cleaning of their portfolios?
Absolutely. You know, you have to position yourself to the end of the year, to the beginning, to see what happens. And, you know, you just have to play the game and let the year unfold. So now's the time to take a look. What worked, what didn't work, what looks attractive, and, you know, what's your allocation that you want to do to go get into the end of the year?
It's been a big year for biotech and pharma stocks as new treatments for diseases are being discovered. So what stocks are you buying?
Well, I own those stocks widely, and my play for healthcare is to spread your chips pretty broadly, because you never know, of course, which stock is going to hit it in terms of what drug or what treatment or what process. Now, one stock I do like is Thermo Fisher Scientific, that supplies all the research equipment to this whole booming pharmaceutical industry. And they became the #1 worldwide provider of this equipment with the purchase of Life Technologies, which has DNA mapping equipment. So that's one of the stocks that I feel is sort of like in the background, but reliable and makes sort of the equipment that all these companies rely on for all those wonder drugs.
That sounds like an exciting stock. What about some areas you would stay away from?
Well, I always tend to shy away from, I'm not going to say the airlines or the car companies or anything like that, but companies that are in sort of industrial parts of the economy where there's huge assets they have to put together. You know, Alcoa comes to mind, and just the economic profits for it aren't as high. So I try to stick to a little bit more of the money managery kind of stocks, your Starbucks, your McDonald's, that have high return on their assets and high profitability measures.
Matt, thanks for being on our show today.
You're welcome, Angie.
That's a wrap for today. As always, feel free to follow us on Facebook and Twitter or send us an email. We look forward to hearing from you. From all of us at First Business, thank you for watching.